Explain the FRBM Act. Do you agree that it ensures fiscal discipline in India?
Has GST curtailed the financial powers of the states under fiscal federalism?
If you are studying for the Indian Economic Service exams, specifically General Economics Paper 4, those two prompts are probably keeping you up at night.
Yeah, they really are the heavyweight questions from the 2025 and 2023 exams. They're unavoidable.
Welcome to this deep dive. Today, we're taking a massive stack of IES revision materials, past year questions from 2010 to 2025, and the latest Union Budget 2026-27 documents.
Right. And our mission here is to shortcut your revision. We want to extract the most critical institutional and policy applications.
Exactly. We're turning a mountain of dry fiscal data into a clear narrative because, just memorizing deficit numbers won't get you through the analysis required.
No, definitely not. You really have to understand the fundamental tug-of-war in India's macroeconomic landscape.
Which is basically that tension between spending to stimulate growth versus saving to maintain stability.
And on the other side, you have the friction between the center's overarching financial control and the state's very real localized spending needs.
So that is exactly the roadmap for our discussion today. We'll unpack the union budget, look at FRBM compliance, and dive into the massive subsidy burdens.
And then we'll transition into federal finance, specifically the 15th Finance Commission and the goods and services tax, since those are heavily tested areas.
Let's start right at the top with the union budget structure. The Constitution mandates an annual financial statement, and the government essentially divides this into two major buckets.
Right. The revenue account and the capital account. Understanding the distinction between these two is really the golden key to Indian fiscal policy.
Let's define the revenue account first. Think of this as the day-to-day operational budget of the government.
Yeah, it's entirely non-asset creating. When money flows out of here, it's going toward paying central government salaries, funding pensions.
And crucially, paying the interest on all the debt the government has accumulated over the decades.
Exactly. It's pure consumption. Once that money is spent, it doesn't generate future financial returns.
Contrast that with the capital account. This bucket is fundamentally about altering the government's asset and liability position.
Right. So capital expenditure is where the magic happens for long-term growth. This is money spent on building physical infrastructure.
Like highways, freight corridors, hospitals, things that actually build the productive capacity of the economy.
Exactly. Which brings us to the three massive deficits that define the government's financial limits.
Let's look at the numbers for the 2026-27 budget estimates. First up is the revenue deficit.
This happens when those day-to-day operational expenses exceed day-to-day tax revenues. The current budget estimate sits at 1.5% of GDP.
Meaning the government is actively borrowing money just to keep the lights on and pay its staff.
Which is a problem because the ideal target for the revenue deficit is 0%.
Right, you want your daily income to at least cover daily survival needs.
Yeah. When a government runs a persistent revenue deficit, it's dissaving, eating into national savings without creating any assets to show for it.
Moving to the big one, the fiscal deficit. This is the ultimate indicator of the total borrowing requirement for the year.
It includes the revenue deficit plus the borrowing needed to fund capital expenditure. The original FRBM Act in 2003 set a really ambitious target for this.
A rigid 3% of GDP.
Right. It was meant to signal to international markets that India was committed to stability after the 1991 reforms.
But looking at the 2026-27 budget estimate, the fiscal deficit is at 4.3% of GDP.
And to truly understand why it's at 4.3, we have to talk about the pandemic shock.
Oh, absolutely. During the 2020-21 financial year, it just exploded to 9.2% of GDP.
Tax revenues plummeted because of lockdowns, while expenditure skyrocketed for health interventions and the PM Garib Kalyan Yojana.
That 9.2% breach completely shattered the old FRBM framework. But, even before the pandemic, the framework is being questioned.
Yes. Back in 2018, the N.K. Singh Committee reviewed the FRBM Act and realized extreme rigidity could harm the economy during a crisis.
So they introduced the escape clause. It allowed a 0.5 percentage point deviation during severe events.
Like a structural reform with unpredictable revenue, a sharp decline in output, or a national calamity.
I always struggle with an escape clause in financial legislation. It's like setting a strict diet but formally writing a cheat day into the contract.
That's a really good analogy.
Does it weaken the credibility of the target? Especially considering general government debt hit 81.35% in FY23, totally blowing past the 60% target.
That tension is exactly what examiners look for. Critics argue it provides a permanent loophole for fiscal profligacy.
Right, because when a government knows it can invoke an exception, political pressure to spend overrides the discipline to save.
Plus, institutions like the CAG have flagged off-budget borrowings in the past, like having the Food Corporation of India borrow from the National Small Savings Fund.
Just to artificially suppress the headline fiscal deficit number?
Exactly. When you combine off-budget borrowing with an escape clause and 81% debt to GDP, you risk alienating credit rating agencies.
But the defense for that flexibility is strong too, right? It focuses heavily on the quality expenditure debate.
Yes, the argument is that the sheer volume of borrowing isn't the only metric. What you do with the borrowed money matters just as much.
If you enforce a blind 3% target during a downturn, you force the government to slash spending just when the private sector is contracting.
Which leads to a deeper recession. It's the essence of countercyclical fiscal policy. You have to spend during the bust.
And the current government defends its 4.3% deficit by leaning on the capital expenditure multiplier.
For 2026-27, they're pushing a record 12.2 lakh crore rupees in pure capital outlay.
And if you add the grants and aid to states for asset creation, the effective capex is a staggering 17.15 lakh crore.
Which is roughly 4.4% of GDP. Let's break down why that capex multiplier is so vital.
Right, because when the government spends a rupee on a freight corridor, it lowers logistics costs for private businesses.
It allows a factory in UP to ship goods to Gujarat cheaper. This is called crowding in.
So instead of government borrowing starving the private sector, the classic crowding out fear, it actually incentivizes them to expand.
Exactly, because the foundational infrastructure is in place. It's completely different from the revenue expenditure multiplier, which just evaporates quickly.
But the fear of crowding out is still real, mostly because of our third deficit, the primary deficit.
Right. The primary deficit is the fiscal deficit minus interest payments. It strips away the massive debt burden from previous decades.
For 26-27, it's estimated at a very narrow 0.7% of GDP.
Which tells a sobering story. The gap between the 4.3% fiscal deficit and the 0.7% primary deficit represents sheer interest payments.
It's basically 40% of the central government's total revenue receipts just vanishing to pay minimum interest on old debts.
It leaves severely restricted fiscal space to fund education or healthcare.
And since they can't easily slash salaries or pensions, the spotlight falls on the massive welfare allocations.
Which leads us to subsidies. Two specific items dominate the budget: food and fertilizer.
The food subsidy under the National Food Security Act is roughly 2.8 lakh crore rupees, and fertilizer is close behind at 1.88 lakh crore.
The policy intentions are good, ensuring caloric security and supporting farmers. But economically, they create massive distortions.
Let's look at the fertilizer subsidy. The government maintains a statutory price control on urea, right?
Yes, it fixes the retail price drastically below the cost of production. Maybe 242 rupees a bag when it should be 2,000.
So the farmer gets an incredibly cheap input, but because it's artificially cheap compared to phosphorus and potassium, they over-index on urea.
The price signal is corrupted. It leads to severe soil degradation and chemical runoff. The farmer applies more but gets diminishing returns.
The exact same logic applies to free power subsidies in states like Punjab or Haryana.
Right. When the marginal cost of pumping groundwater drops to zero, the rational choice is to pump as much as possible,
Leading to catastrophic over-extraction. The water tables deplete by half a meter to a full meter every single year.
These are classic examples of allocative inefficiency. The price is pushed below market equilibrium, inducing overconsumption.
Creating a massive deadweight loss. To fix this, the government has been pivoting toward direct benefit transfer, or DBT.
Utilizing the JAM, Trinity, Jantan, Ahar, and Mobile, the goal is to stop subsidizing the physical product and subsidize the actual person.
So bypassing the leaky supply chain. By transferring cash, you eliminate ghost beneficiaries.
The historical leakage was staggering. The Shanta Kumar Committee in 2015 estimated PDS leakage at almost 46%.
Wow, nearly half the grain wasn't reaching the poor.
DBT aims to plug that, and schemes like PM Kisan act as pure income support, entirely decoupled from production choices.
So the farmer gets 6,000 rupees a year and can make rational planting decisions based on market prices.
Exactly.
That sounds brilliant, but if we look at the raw numbers, the food subsidy is still over 2 lakh crore for 2026-27. If DBT plugged the leaks, why is it still so astronomically high?
It's a function of policy design. The NFSA legally mandates 5 kilograms of highly subsidized grain per person per month to 67% of the population.
That's over 800 million people.
Right. When your legal obligation covers 2/3 of a billion people, the fiscal math is going to be staggering regardless of efficiency.
Plus, the government has to buy the food first at a high minimum support price to protect farmers.
So it's trapped. It buys high to provide income security and distributes at a fraction of the cost, often 1 to 3 rupees a kilo.
Multiplying that loss by 800 million people gets you the 2 lakh crore bill. And funding this is hard because India's tax-to-GDP ratio has historically been stagnant.
Despite being a fast-growing economy, the government struggles to capture a proportionate share in tax revenues.
Mostly due to the parallel economy, or black money, operating outside the tax net.
The government has deployed aggressive tools to formalize the economy, like the 2016 demonetization exercise.
And tighter structural reforms like the Prevention of Money Laundering Act, or PMLA, and strict FATF compliance.
Mandating PAN card linkages and using data analytics to force the informal sector into the formal banking system.
Okay, so we've covered the central government's revenue struggles. But when we look at actual service delivery on the ground, clinics, schools, water, the states do the heavy lifting.
They execute the overwhelming majority of public service delivery, which brings us to the core of GE-04 federal finance.
The constitutional division of fiscal powers, the union, state, and concurrent list, intentionally creates a vertical fiscal imbalance.
The center controls the most buoyant taxes like personal income tax and corporate tax.
While the states rely on relatively inelastic sources like state excise on alcohol, stamp duties, and vehicle taxes.
The aggregate data is stark. States shoulder roughly 60% of total public expenditure, but only raise about 37% of total revenue.
They have a massive mandate to spend, but a structurally constrained ability to earn.
So they are inherently dependent on the central government to transfer funds.
And to prevent political subjugation, Article 280 established the Finance Commission to impartially distribute central taxes.
Let's analyze the 15th Finance Commission's recommendations. The vertical devolution, the size of the pie for the states, was set at 41%.
It was 42% under the 14th Commission. We should clarify for the exam that the 1% reduction wasn't a punishment.
Right. It was just a mathematical adjustment because Jammu and Kashmir was reorganized into 2 union territories, which are funded directly by the center.
But the fiercest battles are over the horizontal devolution. How do you divide that 41% among 28 states?
The 15th FC used a very specific formula. Income distance carries the heaviest weight at 45%.
Then area at 15%, population based strictly on the 2011 census at 15%, demographic performance at 12.5%.
Forest cover at 7.5%, and a small 2.5% for tax efforts.
This formula is basically an intense ideological conflict between equity and efficiency, right?
Absolutely. Income distance is pure equity. Poorer states like Bihar get a higher share to ensure baseline services for their citizens.
Because they have a narrower tax base. But if you're a developed southern state like Kerala or Tamil Nadu, that 45% weight feels unfair.
They argue that they made tough choices to invest in health and literacy, brought their fertility rates down, and grew their incomes.
And now they feel penalized for their developmental success.
Which is exactly why the demographic performance criterion was introduced at 12.5%. It was an olive branch.
So if a state successfully managed population growth, they get rewarded financially here to offset the 15% penalty from using 2011 population data.
Exactly. It's a delicate shock absorber. But tax devolution isn't the only way money flows. There are also grants and aid and centrally sponsored schemes, or CSS.
Right. A CSS is designed and partially funded by the center like the Jal Jeevan Mission, but implemented by the state.
And usually requires matching funds from the state, often a 60-40 split.
The defense is that it ensures minimum standards across the nation. But for a state finance minister, it feels like a velvet straitjacket.
Yes, because it locks up their limited budget as matching funds. They lose the flexibility to address unique, localized problems.
It curtails their fiscal autonomy. And that debate brings us to the most transformative reform recently, the goods and services tax.
This is a priority topic. The 2023 IES prompt asks if GST curtailed the financial powers of the states.
Before GST, states had autonomous power to levy taxes like VAT. If they faced a revenue shortfall, they could just unilaterally raise the VAT on electronics.
They had their hands firmly on their own fiscal steering wheel. But GST fundamentally altered that for one nation, one tax, one market.
It unified the market, subsumed indirect taxes into a dual CGST and SGST structure, and used IGST for interstate trade.
The economic logic is sound. It eliminated cascading taxes and logistics friction. But states had to surrender their sovereign power to the GST Council.
Where decisions require a 3/4 majority, the center holds 1/3 of the vote and states hold 2/3.
It's a consensus model, so the state finance minister traded the steering wheel for a passenger seat on a national bus.
Right. The bus moves faster, but you can't control the route. If a state needs emergency revenue today, it can't just hike GST on its own.
To convince states to agree to this, the center offered a massive sweetener, a legally guaranteed 14% annual revenue growth for the first 5 years.
Funded by a special GST compensation cess on luxury goods. It was a great safety net until COVID-19 hit.
When the pandemic triggered lockdowns, consumption cratered, and compensation cess collections dried up entirely.
Suddenly, the center was legally obligated to compensate states, but the fund was empty.
It led to a bitter standoff. The center initially argued it was an act of God, but eventually borrowed funds to pass on to states as back-to-back loans.
But it laid bare the vulnerability of the states. During a massive macroeconomic shock, they just completely lacked the autonomous levers to protect their treasuries.
So in the exam, you have to present this nuanced reality, acknowledge the long-term efficiency and robust monthly collections, but also the structural centralization of fiscal power.
We've covered an immense amount of terrain today. Let's synthesize the 3 most likely thematic patterns for the upcoming GE-04 exam.
First is undeniably GST and fiscal federalism. Be ready to explain the IGST clearinghouse mechanism and critically evaluate the centralizing impact of the GST Council using the 2020 crisis.
Second is the 15th Finance Commission. Dissect the horizontal devolution formula, specifically the tension between the 45% income distance equity and the 12.5% demographic performance efficiency.
Third is the FRBM Act. Cite the trajectory from the 3% target to the 9.2% pandemic breach to the 4.3% estimate for 2026-27.
And debate the efficacy of the 0.5% escape clause and the NK Singh recommendation to use debt to GDP as an anchor.
Let's pivot to a final provocative thought. Looking at the 2026-27 union budget, there's a fascinating line item. 1.85 lakh crore rupees budgeted for 50-year interest-free capital expenditure loans to the states.
I mean, on the surface, that looks like a masterstroke of cooperative federalism. Free long-term money to spur the CapEx multiplier.
It does, until you look at the conditionalities. The center increasingly ties these funds to specific state-level reforms, like power sector privatization or urban planning.
So there's a catch.
A profound one. As states become heavily reliant on these conditionally tied loans to fund infrastructure because they can't raise autonomous revenues under GST, are we subtly shifting from cooperative to corrosive federalism?
Where the central government uses its massive wallet to quietly dictate state-level policy priorities. If a state uses the center's conditionally approved credit card, whose developmental blueprint is actually being executed.
Exactly. It's a crucial trend to watch.
The numbers in the budget documents always tell a story about the distribution of power. Thank you for joining us on this deep dive. When you face those complex exam prompts, don't just regurgitate the statistics. Analyze the tensions behind them and good land with your revision.